In this video, we are talking about Tesla stock, ticker symbol TSLA. We will address common questions about the stock. Is it a risky investment? Is it overvalued? And will it crash? So let's get into it. The first point I will address is their PE ratio, or price to earnings ratio. This is an important concept that value investors regularly use to assess a stock's current price. To get the ratio, you take the share price and divide it by earnings per share. Typically, value investors like to see a ratio between 12 to 15, but Tesla's ratio is significantly higher, coming in at 781. So what does this mean? 1, it could be overvalued. 2, there could be high expected future growth. Or 3, they could be reinvesting their profits to grow faster. In 2015, Tesla CEO Elon Musk made two predictions: 50% annual growth and 500,000 vehicle deliveries in 2020. As you can see, Tesla's total revenue is $4 billion in the fourth quarter of 2015. Fast forward to the third quarter of 2020, and now we're at $28.2 billion. This adds up to an annual growth of 48%, just slightly under the predicted 50% growth. Vehicle deliveries. In 2019, Tesla delivered 367,500 vehicles. This represents a 50% increase from the previous year. Tesla's quarterly vehicle deliveries continue to follow the exponential growth curve year after year. So far in 2020, they have delivered 318,350 vehicles. Keep in mind that they still have 1 quarter left in the year to meet their goal of 500,000 deliveries. If they achieve this, this would mean a 37% growth in 2020. This would of course be under the predicted 50% growth. However, keep in mind that we are in the middle of a global pandemic, and while the growth of rival auto companies like Ford and GM are decreasing by 30% or more in 2020, Tesla continues to expand by reinvesting their profits in order to build more factories. Their plan is to invest $12 billion in the next 2 years to build more factories. This will result in even more future vehicle deliveries, which will then result in higher profits. Those profits are again used for future growth, and the cycle continues. They have a very specific plan to continue to grow at an alarming rate with a clear mission in mind to accelerate the world's transition to sustainable energy. And they're doing this with a purpose, almost with a vengeance. This is reflected in the stock price, as both institutional and retail investors are finally starting to realize this. But then comes the next question: will the stock price crash? Just to be clear, nobody can predict what the price will do, but we can make some comparisons and infer. You might have heard about a little-known company called Amazon. Say what you want about its CEO, Jeff Bezos, very much like Elon Musk, has incredible conviction, knowledge, and a relentless drive to make the company a global success. Let's take a look at Amazon's PE ratio. In 2012, it peaked at 3,633. This scared away a lot of investors who made their investing decisions based on PE ratios. However, if you invested $10,000 in Amazon stock at this time in 2012, you would have $123,000 today. The reason I make this comparison is that Tesla is still a very young company, and they aren't focused on keeping every cent of profit for themselves or giving it back to their investors in dividends. They are in their rapid growth stage, which means that their PE ratio will remain high and scare away a lot of investors. I can't predict the future, but I have a strong feeling that these investors will regret not buying the stock at these price levels, as they will seem very cheap compared to what they will look like in 10 years. Here are my thoughts. Tesla is not overvalued. They will continue to grow at a rapid pace for many years, and they will continue to reinvest their profits into future growth. As a result, the stock price will continue to go up. Thank you so much for taking time out of your busy day to watch this video. Please leave a comment below, like the video, and subscribe if you want to see more.